Welcome to Galaxy Brains.
An infinite amount of cash.
I'm your host, Alex Thorne.
The U.S. banking system is sound and resilient.
Bitcoin made a new all-time high.
If you're not long, you're short.
Satoshi's going to come on there, laugh hysterically, go quiet. All Bitcoin's going to be erased.
Bitcoin's the best crypto asset.
Bitcoin is going to zero.
Welcome back to Galaxy Brains. As always, I'm your host, Alex Thorne, head of firm-wide research at Galaxy. Bitcoin's not zero, and we have a great episode for you this week. Nick Carter, founding partner of Castle Island Ventures, is back. He's a repeat guest, and we're going to talk with Nick at length about a bunch of interesting topics. The Genius Act, the stablecoin bill that just became law, was signed last Friday by the president at the White House. What does it mean for banking and payments in the United States? Is it like free banking? I don't think it is. Nick doesn't think it is, and he's going to explain why. But it is like narrow banking, and what is the impact going to be on banks, payments, bank deposits, the Fed, money supply? Very interesting conversation about stablecoins with Nick. And we'll also talk with Nick at length about AI. He's a big investor in AI companies, and we talked with him a year ago on this show. The episode, I think, was called Why AI Will Take Every Job. We're going to talk about whether young people who grow up with AI, are they cooked? Are they going to be able to learn how to write and critically think? We're a little concerned, and we'll get into it on those topics. We'll also check in with our good friend Bimnet Abibi from Galaxy Trading, as always, to talk about markets. And he and I are going to debate, is Fed independence a good thing? Is it American at all? Does it make sense to exist? What would happen if there was a different Fed chair? It's a fun conversation with Bimnet, a little bit longer than usual. Before we get to that, I need to remind you to please refer to the link to the disclaimer in the podcast notes, and note that none of the information in this podcast constitutes investment advice or an offer, recommendation, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. Let's hop right into it with Bimnet Abibi. Let's go now to our friend Bimnet Abibi from Galaxy Trading. As always, Bimnet, welcome back to Galaxy Brains.
Thanks for having me.
So things are looking good. You're looking at stocks at all-time highs again. I feel like a little bit of a broken record. We've been talking about how stuff looks pretty good. Just before we get to we're going to talk more about the Fed this week. But before we get to that, what are you seeing, in the economy and the markets over last week?
I think the most important developments over the past week are with respect to trade deals. We've struck a trade deal with Japan, and there were headlines hitting this morning that suggested that the U.S. and the European Union are close to a deal that struck at 15% tariffs on EU goods. And so, the market is viewing that favorably, and equities are generally trading well. I think getting through the EU and Japan and China, those are kind of our three largest trade partners, is an important step to kind of clearing the kind of market congestion about trade policy, because we had this upcoming August 1st deadline. And so, now that we're past that, it kind of seems like we're in summer complacency mode where data is good. Monetary policy is expected to be easy. Fiscal is highly supportive. And so the natural drift of stocks seems to be higher. And, that's helping support crypto price action to a certain extent. But I really don't know if that's going to stop before we finish the summer. And so, I think the backdrop for risk looks pretty good. The risks to that view, I think most notably are with respect to Jerome Powell. Is he going to be staying on? Is he getting fired? I think some of those risks abated because, Trump said he wasn't going to let him go. But there's still a lot of chatter from Secretary Bessent about, reviewing the Fed, some chatter from Congress about, potential new legislation regulating the Fed. And so, there's still some of that in the backdrop. But ultimately, again, those risks are probably constructive for BTC, gold, the short dollar trade, and nominal assets like equities. If the Fed's going to be much more aggressive cutting, if we're going to just broadly maintain easier monetary policy, that should be good for stocks, gold, Bitcoin, and the short dollar trade. So, even with the kind of risks out there, it's still a reasonably attractive time to be long risk assets.
Yep. And we've got earnings season upon us now. I mean, have it's not completed yet, but have things look okay?
Things have looked just fine so far. But again, it's really hard to tell because the earnings game is one that I've just always so skeptical. Because if you look at, like, there's a page on Bloomberg, it's EA earnings analysis, and you can look at it for, a bunch of quarters, and essentially, like 60, 70, 80% of companies beat earnings expectations all the time. And I'm like, okay, so if we had a reasonable distribution of earnings, like, you would expect like 50% of companies to beat, not like 60, 70, and at times like, higher than that. And so there's a little bit of gamesmanship being played where, research analysts are kind of expected to keep earnings reasonable and meetable. And so, when you see those headline figures, they don't necessarily represent, the broader consensus. Those are just, numbers on a piece of paper that are kind of, set such that, these companies can look like they're doing well. So, I think right here, right now, the tariff uncertainty is going away. So you should see less chatter about tariff uncertainty in earnings calls. And that'll broadly be constructive. I think some of the, executive orders with respect to, AI are going to be received pretty well. And generally, like, you just have to think, like, there's trillions of dollars coming into the market from fiscal. So the backdrop is good.
Yep.
And if we don't have trade wars happening, like, it just doesn't matter as much.
Yeah.
Nothing ever happens, basically.
Nothing ever happens. Speaking of which, on Nothing Ever Happens, we talked a lot last week and during this segment about whether or not, well, not so much whether or not, but what would the impact be on the Fed, on the markets, on American monetary policy and economic policy if the president were to fire the chair of the Federal Reserve. Shortly after we recorded, Trump came out and said, I'm not going to do it, and denied that there had been a letter pre-written that some had seen and stuff like that. I saw just earlier today, we're recording on July 23rd, earlier today, Secretary of the Treasury Scott Bessent said, I'm not sure where that question comes from. President Trump has repeatedly said he's not going to fire Chair Powell. He might like for him to resign, but he's not going to fire him. So it sounds like, at least in the interim here, the idea that the president would fire Chair Jay Powell, Fed Chair Jay Powell, is off the table. What's your sort of updated thoughts on this? Since, Mohamed El-Erian, who used to run PIMCO, came out
and he was at Allianz. I think he's still at Allianz.
Yeah, he said that he should resign in order to preserve Fed independence. There's a lot of conversation here about Fed independence and Jay and the president, and so I don't know, where do we stand in your mind?
Yeah, I don't necessarily think that the Federal Reserve chair in the current economy is really that important from the standpoint of, like, he's the person setting policy. I think the market is far more important in terms of guiding, where Fed policy should be, from the standpoint that, if the Fed pursues an overly dovish path, right, you will see a reaction in the market. Like, the dollar will sell off super aggressively. If we harm the credibility of the Fed in a meaningful way, again, the dollar will sell off, super aggressively. And, that might mean less treasury buying. And so, and equities might sell off, really harshly to Powell getting fired. That's a certain possibility. But it all goes back to the point that the market is really going to drive the set of outcomes, right? If you see, people stop buying the back end of the curve, the dollar selling off, like, the Fed's not going to just, continue to, press policies that are leading to those outcomes. And so, if it's Warsh, Hassett, or Bessent, or whoever it ends up being, like, they will take their cues from the market. And so, ultimately, I do kind of, like, see where El-Erian is coming from, partially from the standpoint that, Powell is kind of too entangled in this, like, political back and forth between the administration and the Fed, and a new Fed chair, would have a term that, outlasts the current president, and they're going to be kind of forced to abide, by the market. And so, there is a reasonable argument to be made that, Powell stepping down, might ultimately help the Fed's credibility at this point, because, it's going to be hard for Trump to attack a Fed chairman that, he just put in place. Right. And if that Fed chairman is going to decide to pursue, less easy monetary policy because that's the appropriate policy path, and that's what the market's kind of guiding him to do, Trump can't just go on Truth Social and be like, oh, this Fed president is stupid and is acting irrationally. Well, dude, you put him up there. And so there's an argument to be made that, Powell resigning, might actually help the Fed's credibility in a way.
Interesting. Let's have a little bit of a debate here, okay,
Sure.
about Fed independence as a broader topic. And I think we both agree. I know you've spoken eloquently about it on this show many times. I also agree that Jay Powell has been a very effective and a good Fed chair given the circumstances, which have been tricky. I mean, COVID was unprecedented, and but setting him in particular aside, I contend that Fed independence is un-American. And in fact, it's directly opposed to the Constitution. Article 1, Section 8 specifically delegates the power to coin money to the Congress. Now, Congress, of course, did redelegate the power, abdicate, I would argue, to the Fed in the Federal Reserve Act. But I'm happy to go into more of that argument. What's your reaction to that?
Yeah, I think the Fed needs to make decisions that are hard. They need to have the bandwidth to, sacrifice the short-term good for the long-term gain. And nothing about the U.S. political system, is conducive to that, right? Politicians base their decisions on election cycles, right? 2-year election cycles for congressmen, 6-year election cycles for senators, and basically, a normal president, especially a first-term president, they've got like essentially 2 years before they have to start running for re-election. And so that leads to like very populist outcomes, versus like monetary policy. Like, you want the dollar to be around and strong for your kids and their kids. And so, I think the separation, that the Fed has and the independence that the Fed has is definitely warranted. And that's partially the reason why, like, up until, like when Trump came to power, right? Like, the dollar was on this crazy strong path, right? Like, euro was at 104, like, it was the perfect risk off hedge, high carry. The government can print as much as they wanted. And so it's been working just fine, with some blips along the way. But I would argue that the outcomes have been better than if, the Fed was, a little bit more related to Congress and, had more regulations and less independent. Like, I think you've had better outcomes in this construct. Now, is it un-American? You could make that case. But has it led to much better outcomes? I would strongly argue that it has. And so I'm more in the camp that, you keep Fed independence. You don't change the legislation around, how the Fed operates. If it ain't broke, why fix it?
Yeah, I think that's a fair point. And I guess the question to me might not be independence. I love the idea of that in general. And you're totally right about the perverse incentives that our political system imposes on politicians today, and whether, monetary policy should be in the hands of those incentives.
I mean, they're just not even experts. Like, you ask, like people talk about like 300 basis point cuts in interest rates, like they're nothing in Congress. They don't even, like, some of them don't even understand. Like, I've seen people go on TV and be like, oh, the Fed should cut by 3 bips. I'm like, do you even understand what you're saying? And so, like, I just don't think there's a technical know-how in Congress to regulate something so important. But you could make that argument for medicine or for
and other things that they
AI.
do regulate.
And
Yeah.
I would argue that, if you had an independent board of like AI people that, were about public service and we're patriotic and we're just trying to do, good for the overall population, you might end up with better outcomes. which is kind of what we have now with the Fed, right? Like that's if you had like subject expertise people focused on that subject for the U.S. population, like you might get better outcomes.
I think that's a strong case. Let me just give a little bit of the sort of some history, some quotes from founding fathers here as to why it took until 1913 for a true central bank to emerge in the United States with the Federal Reserve Act. Thomas Jefferson, I believe that banking institutions are more dangerous to our liberties than standing armies. He also said the issuing power should be taken from the banks and restored to the people to whom it properly belongs. Now, some of this was in the context of Hamilton's creation of the First National Bank, which in my view was less about monetary policy and more about centralizing American state debt in order to get better credit.
Yeah, but I would argue that Alexander Hamilton would definitely be pro-Fed.
Yeah, he would. No, he absolutely
100%.
would. Although I think, my read of history is more that it was less about controlling monetary policy and more about centralizing American debt. But agreed, I think he would. I would say Washington was ambivalent. He did sign the charter for the first bank of the U.S., but only after deep consultation. Madison said history records that the money changers have used every form of abuse, intrigue, deceit, and violent means to maintain their control over governments. Obviously, Andrew Jackson, not a founding father, but often included, in this discussion, called them a den of vipers. I intend to root you out to bankers at a meeting during the Bank War of 1832. That doesn't matter. I'm not the type of person that says that, 250 years ago, people said this, so that's how it should be. But I would point out that, coinage was a very important part of the founding of America and the liberty that the people wanted restored to themselves. Now, it is restored to themselves. Like I said, in Article 1, Section 8 of the Constitution grants it specifically to Congress, and Congress itself delegated it to the Federal Reserve and created it. I think my problem with the Fed is its lack of accountability overall, right? So even now, and actually have a monetary policy isn't even the main one that I don't like. It's bank supervision, which is not, we talk about their dual mandate of, in the context of monetary policy, of maximizing employment and minimizing inflation. It's really a triumvirate mandate because they also supervise the banking system. But that's in a manner that I would argue is wholly redundant. You've got the FDIC, the OCC, state bank regulators. And in particular, when the Fed does things like what we have alleged, is called Operation Choke Point 2.0, right? No accountability for that. No, why should an unelected, unresponsive to congressional oversight agency have these powers, right? That where they are, I think the OCC and these other banking regulators that are much more, are much closer to the people's agency are themselves, plenty effective than the Fed. Doesn't mean I don't think it's useful
on bank regulations. There's enough out there and enough agencies that do it. I'm in complete agreement there. But
then the last point though is only seven members of the Fed's Board of Governors are actually at all related to the power of the people. They're appointed by the president and confirmed by the Senate. They can't be removed from their posts. No decisions they make are subject to congressional oversight of any form. There is no comprehensive audit of decisions they make or why they make them or accountability after the fact. So perhaps you could have some independence with maybe a lever or two more that gives them a little bit more accountability might be the sort of a middle ground that I would suggest.
Yeah, I mean, it's possible. But is the Supreme Court accountable?
Yeah, but they're a third branch of government in the Constitution. This is merely a pseudo-public entity established, 110, 112 years ago. This creature from Jekyll Island. But how would you
hold them accountable? It's like, I can end your term early.
Well, you could have something like a Congressional Review Act, which requires a 2/3 majority to overrule, or some kind of. You could set some threshold for reviewing their decisions. I'm not. Don't get me wrong. I am very, very sympathetic to your argument about this U.S. Congress, modern U.S. Congress's capability of doing long-term decision-making, which in many cases is unpopular. Very unlikely they would do a good job at that.
But I would argue that, don't let perfect be the enemy of the good in this situation, right? There is probably a more perfect structure for the Fed, better regulations, get rid of banking supervision, have some more accountability. But, that gets in the way of all of the good work that, the Fed is likely to do, if it continues in the current construct. And so that's kind of my philosophy. Now, maybe that's insufficient because we're at a point in markets and in the debt and with fiscal spending where, we really need to have a Fed that is thinking, for the long run. Um, but it's hard. It's hard. I'm on Team Powell. I'm on, keep the Fed independence, keep things as is. It's working just fine. But again, you know, like there's a lot of things I would want to do if I was in the Fed, right? Like I would, much more aggressively run off the balance sheet, for example. That would cause, long end bond yields to go up a ton, right? That would be super painful for anybody that's trying to buy a home or sell a home. But what would that do? That would probably incentivize Congress to spend much less money, right? But that's not going to be a palatable thing for a lot of people in the world. But that is probably the right thing to do.
Yeah, that
Right?
would lead to like pitchforks calling for BIMNET's removal of Fed chair, probably, right? I mean, it's so tricky. Like, I hear you. I think, and by the way, like, I'm not sure that I'm actually in the camp of as particularly as it relates to monetary policy, actually removing the Fed's independence. But I do think, maybe not so much as it's been floated by the White House this go round, I do think it is reasonable for people to criticize and ask for
Yeah.
changes at the Fed, generally speaking.
But I mean, have you seen Powell at these press conferences? Like he answers every single question,
Yeah.
right? He has a very rational response and he analyzes the data. Like going back to Janet Yellen before him, like, these guys are these Fed presidents, they're citing research. They're using models, right? They are constantly trying to improve themselves, right? They do Jackson Hole last year was about inflation targeting. Like, is 2% like a really effective target? Like, why are we still using that, right? So they're constantly trying to evolve and evaluate the decisions that they've made, and so like I don't think you can ask much more of them.
Yep.
From that standpoint.
Two last quick points. One, one of the looked like groundwork had been being laid by the president's allies in Congress, and even the vice president, I think, had mentioned something about the cost of renovating the Federal Reserve's headquarters in Washington. Apparently, it's now exceeding $2.5 billion. It is a historic building. It's probably filled with asbestos and expensive things to remove. And last week, you made the point that, well, sure, if you budget $500 million 10 years ago, surely just dollar depreciation alone means it ends up costing more. I do want to point out that the Fed's renovation project, the Fed's budget in general, is paid for by the Fed. It is not paid for by Congress. The Fed can pay for it from appreciation of securities it holds on its balance sheet, among other sources of its own money. So it seemed to me a particularly egregious reason to cite for removing the Fed chair. It's their money. It's literally not the people's money.
Are we accounting for all the mark-to-market losses that they've had historically?
I'm not sure. That's a good point.
Buying like a ton of debt when rates were really zero, and
yeah, we should actually do that. How profitable has the Fed's investment truly been over its history? How much money have they lost?
Well, they hold to maturity a lot of times, and but yeah,
surely interesting.
I think that's a super valid point. But
the last one, just for our audience, the poly market. Now, this would be if Trump were to announce a new Fed chair before December 31st, the end of the year. Currently, 22% is Kevin Warsh. Is he Council on Economic Advisors or one of those things? I can't remember if he's the National Economic Council or
National Economic is
Hassett.
Yeah.
So Warsh is in one of those advisory economic roles. Kevin Hassett is in another. Kevin's at 14%. So Warsh at 22%. Chris Waller, who's the current governor for payments at the Fed, who actually, in my upcoming interview with Nick Carter in a few minutes, we play a good clip from Governor Waller about stablecoins. So it goes Warsh at 22%, Waller at 17%, Hassett at 14%, and Bessent at 11%. And you made this point, like markets are probably going to drive monetary policy more than any individual. So it might not even matter.
It just won't. It just really won't. Like, 25 bips here, 50 bips there. Like if inflation comes back, we're hiking, right? If the market responds super poorly on the FX side to those cuts, like, folks will be aware. And the Fed's going to get grilled why the dollar is depreciated another 10% after depreciating like another 12-13% before that. And then you're going to be like, oh, the Fed, Trump's coming to power and the dollar's gone off by 25%. Like, that's not a good outcome. And so, I really do think that the market will do some of that work. But at some point, I really want to double click on that stablecoin stuff that we've talked about. I think it's really interesting to think about, like, folks talking about like, oh, stablecoins launching, like that should mean, a stronger dollar. That should mean, faster velocity of money, and more demand for US dollars. But like, fundamentally, like, unless more dollars get printed, like, just because you have a stable coin doesn't mean that there's going to be like more dollars out there, right? Like, it's not like, I think people are misunderstanding that, and now you're seeing like, oh, a lot of congressmen and officials are like, oh, that's going to lead to trillions of dollars in demand for dollars. Like, that's not how that works.
Yeah, is it going to just recycle the demand
It's
from
just
elsewhere or whatever?
recycling. Like,
Yeah, well, let's get
money
into that. We've
supply-
already gone pretty long, but let's
I
have
know.
that debate too. Also, what it means for the future of commercial lending and bank deposits generally is a great question too. But we'll leave it here for now. A nice rip here with Bimnet Abibi, my friend from Galaxy Trading. Thank you so much.
Thank you for having me.
Let's go now to our guest, Nick Carter, founding partner at Castle Island Ventures. Nick, welcome back to Galaxy Brains.
Thank you, Alex. Great to be here. I think this is my third time.
I think it is. It might even be your fourth time. Might be third time. Yeah, maybe third time. Because I think it is your third time because you came on early. I think you were one of our first guests. And then you came on, I think you were one of the very last guests before we started doing video, right around the FTX collapse, I recall. And then you came on last year.
I know. Yeah. And then last year we talked about AI.
Yeah, that's right. So we're going to talk more about AI this year because, I mean, that story keeps evolving and advancing. But before we get to that, I wanted to congratulate you. Maybe was it your first venture, Coinmetrics, you were the founder of, was just acquired by Talos Trading. Congratulations.
Thank you. Yeah, we're very excited about that. That was the very first company I started ever. I mean, it's kind of like a little strange because, I started this kind of open source website, with a friend that I met on Reddit in 2017 when I was in business school. And it wasn't really a company until November 2018, I think. And then we actually raised some money for it. And then I brought on Tim Rice as the CEO. And he ran it since then. So I haven't had like a day-to-day role at the company since then, but yeah, very, very happy with the outcome. And Talos is a great company. I think it's a very good fit.
Yeah, I think so too. And the merger of trading technology and trading markets and market data, I think mirrors the traditional world when it comes to how sort of these data businesses evolve typically, right?
Yeah, I think it's a very natural fit. CM has expertise delivering low latency market data as well as obviously the network data suite, and it pairs very well with Talos's offering, which is actually they have like 5 or 6 lines of business now actually. So, and honestly, data is a very hard business. It's a hard standalone business. I always actually figured that it would pair well with a more traditional like trading style business.
It's always interesting too because market data, and I want to talk about the network data in a second because Coinmetrics was one of the big pioneers there, and you were as well. But market data, don't the exchanges in traditional markets typically sell that data? Like the orders and execution data and the trade execution data is usually sold by like NYSE and NASDAQ themselves.
Yeah, it's like 20 to 50% of their revenue is the
But
data.
In crypto, the exchanges give it all away for free, basically.
Yeah, we have this weird social convention where all the market data is free. And so then it's very hard to actually sell the data.
Yeah. Well,
So-
Coinmetrics is one of the only, there's a couple others that have existed. Surely Amber Data and Keiko.
Those are basically the 2 other institutional focused outstanding data companies. I mean, it's like, what's that expression? You just sit by the side of the river and watch the corpses of your enemies float down or whatever. That's probably not it. Sounds like really mean or whatever, but I can't tell you how many data companies I've seen come and go over the years. We'll see more consolidation too, actually, in that space. There's some good new on-chain data companies too. There's a new breed.
That's what I was going to say. Is the now looking at the on-chain and network data, where you in your graduate program and I remember the earliest iteration of coinmetrics.io. I encourage people to use the Wayback Machine to see what that UX was like. Very useful. Not, I wouldn't say beautiful from a user experience standpoint, but totally functional.
I actually loved the legacy
I did too.
visualization
I did
tool.
too. You should do like a BitMEX just did a legacy UX thing, or like or no, somebody did, and Johnny Beer and BitMEX were saying like we should do it too, like show what the oldest UX used to look like for. I'm also thinking of like Polony. I was like on Poloniex and Coinmetrics and like the early BitMEX, and all those UXs are very nostalgic for me. The same way like looking at like CS Assault or DE Dust and like old Counter-Strike maps or things is.
Yeah, our UX was written in Haskell from the ground up. It was highly performant, as you probably recall. Not pretty. It was not pretty, but it was very performant.
You could you could do some custom queries in there as well.
Yes, we had a very powerful formula builder tool. Oh man, those were the days.
So since then, though, I would say unlike the institutional quality market data space, the on-chain data space is like highly competitive, and there's a lot of players, right? From free, semi-free to paid ones, things like Arkham and Nansen and Glassnode and Coinmetrics and all the DeFi llamas and RWA.xyz's, all these websites that give either it away for free or like there's a lot of data. Dune and Flipside, I think, are also great, very powerful examples for custom queries. Like there's a lot of people on that side of the market.
Huge. I remember when Dune came out, we actually sent Dune a term sheet. We didn't invest in the end, but we sent them a term sheet for the price for the seed. I remember seeing Dune and thinking this is the future of network data. And actually, if I'd still been running CM at that point, I would have pivoted into more of a Dune approach because I loved the flywheel of user-generated content. It's an incredible product, Dune.
Yeah, but Dune is great. I would say our team also loves Flipside's competitive product to Dune. They have a similar, like custom data, normalized databases where you can build custom queries on top. And I think my understanding, I'm not like the data guy on my team, but that Dune's databases are not like harmonized across chains. So like there's all these nuances if you're going to like make a Bitcoin dashboard on Dune versus like an Ether or a Sol or an NFT or whatever. Whereas Flipside has really clean like cross database harmonization, right? Like better taxonomies, better, both very powerful though.
Yeah. Allium and Artemis are two newer entrants as well. RWA XYZ is good on the stablecoins front. There's a ton of great companies in the network data space. It's also a very hard market to be in. I'll tell you that. The TAM and data these days didn't grow as fast as I thought it would, actually. I think this year might change, more institutionalization, but extremely challenging business, to tell you that.
Yeah, I think if you get one that might grow the TAM and revenue, and addressable market for those companies and investor types that would be buying that data would be if we got tokenized equities, right? If you started having, and then you need real high quality data on what is effectively securities on chain, which surely like the on chain analytics firms could be poised to deliver to, I don't know, traditional markets.
Yeah.
Be interesting.
Open questions about the legality of the tokenized equities, I think.
Yeah.
We'll see.
I agree. We've been very critical of the token wrappers. Obviously, Commissioner Peirce put out a statement too, saying she was. Well, I wouldn't say she said she was critical. She signaled some criticism of it, and just reminded that those would be securities as well, likely under their analysis. But yeah, it still remains to be seen how. I should say if, how, and when the SEC would allow real tokenized equities, but. Seems like we're marching towards that, doesn't it?
I think it has to be issued directly by the corporate entity for it to really work. So I'm skeptical of these Luxembourg, SPVs that are tokenized. And also, we're now seeing it for private companies, tokenized equity for late stage privates. That's even more complex because you can't really arbitrage, a derivative against private late stage. There's no way to really short if you think about doing that arb between the publicly traded token. Like you can't close it because you can't express your short view. Sometimes you can't even express a long view either.
Right. Yeah, and those you would surely need the issuer's permission to do, because they can approve and deny all secondary trading of those non-listed securities, right?
Typically, yeah. I mean, sometimes you have these SPVs and you end up with nested SPVs. I saw a 3x nested SPV on Anthropic today.
So what is that? Is that an SPV owns shares in Anthropic, or like invested on a primary basis, and then another SPV bought shares from that holders of that SPV? And you're saying a 3x, so then yet another SPV bought?
A third layer with the whole time you've got 1 in 10 fees. It's
oh my God.
You're getting such a small piece of the pie once you get to the third level of recursion there.
And is that due to like significant, like enormous demand in, say, in this case, you said Anthropic, like in ownership of pre-IPO Anthropic shares, that like people are willing to stomach that apparently?
Yeah, I mean, it's kind of a weird cottage industry that's cropped up now. You know, these companies are staying private so long. There's ample liquidity in private markets, and you just get endless intermediation there. And it's like, this is why you should go public, man. Like, you're worth $100 billion. Just go public at that point.
Well, we have been seeing, maybe that will shift. It has been a historic, larger and larger private pre-IPO venture-backed companies over the last, decade plus. But maybe it seems like there's a bit of a gold rush now with public markets. Maybe we'll see a shift in that. Sticking with tokenization, another thing that could drive, I think, demand for on-chain data products would be increased. We said about tokenized securities, but how about tokenized dollars? It looks like we stand on the precipice of an explosion of crypto dollars or digital dollars because of the passage of the Genius Act. What's your reaction to the, Genius Act is now federal law?
Yeah, I mean, I watched the press conference, I guess, when we signed it. Saw a lot of friends in the audience there. I thought it was the second or third most important political event in the history of crypto in the 15 years. So I think Trump's election was important, obviously. The approval of spot Bitcoin ETF, and then Genius Act. I mean, Genius Act's the first ever pro-crypto piece of dedicated legislation ever. And it completely ratifies stablecoins, establishes the federal framework. It really does a lot to silence the critics, too. I mean, these are very safe instruments at this point with the framework and the restrictions that domestic issuers have to face. There's open questions actually as to, what will become of Tether. They have a few paths under Genius. I think it was actually overall a very good outcome for them. They have this 3-year grace period before they have to sort of make up their minds. They could potentially launch a U.S. stablecoin, or they could be determined that they are operating under a comparable regulatory regime. I suppose in El Salvador is where they are right now. I actually think there's a dark horse likelihood that is the determination. So I think very good outcome for Tether. Genius clearly allows U.S. financial institutions to get involved in stablecoin issuance. I think there's actually, it's much bigger than even crypto. I think it's a change to the nature of banking in this country entirely. I think it inculcates a narrow banking framework, which is what banking theorists many have been hoping for. So I think it's a total structural change as we move away from commercial bank intermediation and move towards firms and individual retail holders having exposure to having a relationship with the Federal Reserve directly, as opposed to having to go through the commercial banking system.
Can you expand on that, on the narrow banking concept? Like, what is narrow banking? Why are these narrow banking and versus fractional reserve banking?
Yeah, I mean, normally banks have this very cheap source of capital, which is deposits, and they don't pay very high rates of interest. And, you are exposed to the bank solvency. We saw what happens in 2023. Sometimes things go pear-shaped. And then the bank has that relationship with the Fed, so it's really a tiered, highly intermediated system. The banks doing lending, et cetera. Narrow banking cuts out the middleman, and you get exposure directly to the Fed. In theory, the Fed's paying you interest. So, the Fed issues the liability, and then you're in theory able to utilize that. You don't need to go through commercial bank. There was a thing called the narrow bank, TNB, which the Fed disallowed out of concern that it would drain deposits from the commercial banking system, because of course we in the US think it's a generally good state of affairs that banks are injecting credit into the economy and doing lending for small businesses, for mortgages, et cetera, et cetera. So banks have this kind of dual mandate. Narrow banking potentially disintermediates all of that. That's why it wasn't allowed in the past. Now through Genius, we effectively have, in my view, stablecoins are narrow banks, especially if they can find a way to pay interest indirectly, which I think they will do. I don't think there is actually a way to prohibit interest provision through intermediaries the way Circle does it. So now you have stablecoins, which are going to have access to the Fed directly, in my opinion. I mean, Chris Waller said that recently in a speech. Or they're just holding treasuries and giving you a transferable liability that's basically redeemable from the underlying. So it's like a money market mutual fund, but you can actually buy things with it and use it as collateral. And yeah, it's actually transferred. It's not just sitting in a brokerage. It's totally interoperable. So in my view, stablecoins are narrow banks, especially if stablecoin issuers get these banking charters and things like that. And I think it's going to continue with this trend that we've seen for the last few years, which is this flow out of commercial banking deposits, especially unsecured, into owning treasuries directly, or owning basically direct liabilities of the Federal Reserve. And that is a huge systemic change in the nature of banking in this country. Some people are afraid of it. I'm not. I think it's warranted. I think the system as it existed was very unsafe and very ambiguous as to whether your uninsured deposits are secure or not. We don't need that ambiguity. But I think it's going to challenge commercial banks hugely.
Yeah, I think it is too. And I think your point about it is when you own I think the reason why it's fair to call it narrow banking, and you're right, it becomes more compelling to call it that if the issuer itself is itself a bank, whether it's a fintech that gets a banking charter, or if it is an existing bank. But another reason to call it that is because Genius sets extremely high uniform standards, right? So whether it is, Alex Thorn Inc. or, Circle or Nick Carter Limited that issues the stablecoin in the US, to be legal, we all have to achieve an extremely high bar for collateral management, for bankruptcy remoteness, for AML KYC, for all of those things, right? It sets a uniform standard, which sort of makes it a whole, although you will have different issuers, it makes it one giant pile of fungible dollars, right? They should be fungible under this system. Do you think that, one of the reasons because the Genius Act does attempt to explicitly ban paying yield to token holders. And I think it would ban, say, Circle, like if I hold one USDC in my non-custodial wallet, them literally airdropping down the yield to my token. But you talked about intermediaries, right? Right now, Coinbase does pay yield on USDC deposits at Coinbase. Why is it that you think they'll be able to pull that off, even given the ban? What is the argument behind that?
Yeah, yield is the crux of it. If yield does become a feature of stablecoin systems, as it kind of presently is, then the narrow banking analogy is real. It's actually just literally narrow banking at that point. The ABA, the American Bankers Association, sent a letter, I think maybe directed to Congress or Treasury, saying you need to make sure that those anti-yield provisions are enforced in Genius. They're very concerned about this. And banks, this is because banks haven't covered themselves in glory at all. They don't pay market rates at all, right? I don't know what your high interest savings offers, like 2% maybe. So of course, if you're comparing a commercial bank deposit that pays you 2%, and if it's over 250K, it might, the funds might literally not be there. So it's much less secure. You're comparing that with a money market fund or with a stable coin that acts like a money fund, the latter is far more secure. It's just a much higher quality liability. So, I think for accounting purposes, there's no way to actually write a law such that an issuer cannot pass along an incentive that is yield flavored. I just don't think it's possible. You don't have to describe it as a yield, and you don't have to pay it on chain. With Circle, you hold USDC at Coinbase, you're getting a kind of an incentive payment, which they don't call a yield. I think it's like a marketing expense or something. How do you stop that happening? And stablecoins, yeah, I might hold them non-custodially, but increasingly there's intermediation in the stablecoin sector through these payment service providers, the Bridges of the world, the orchestrators, through custodians, through exchanges, through fintechs now. Those intermediaries will be the vessels, through which this yield is distributed. So de facto, you will have a positive yield-bearing stablecoin situation. And if you're looking at a PYUSD, really any Genius regulated stablecoin, that is something you're much more secure holding than certainly an uninsured cash deposit in a bank.
Yeah, I think you have FDIC insurance up to $250,000 right per account for a bank deposit, but that certainly doesn't cover the entire banking system at all, not even remotely close, right? But you still end up in tricky situations if you look at like Signature and SVB and other banks that collapse because the deposits aren't there, right? Like they're not there. In the case, you are taking, by definition, some credit risk to the individual bank where you deposit your cash with some FDIC mitigation. And, if you're lucky enough that your bank that collapses is deemed so important, then maybe the Fed just steps in and backstops it anyway. But these are fully collateralized stablecoins, right? There shouldn't even be even in the sections in the Genius Act. I think section 8 and 10, which sort of describe the bankruptcy remoteness. Even in the case of a bankruptcy, you're not just holders aren't just don't just have primacy over all other creditors. I think the estate is required by law, and the courts are directed to just let the people withdraw within 14 days if the assets are there, which they should be there because they're required to be there, and bank examiners are going to make sure that they're there. So it truly is like safer in some ways. It should be safer than a bank deposit.
Far safer. And I don't want to get in trouble by saying this, but I can't even conceive of what a run on a stablecoin would look like. And I know everybody's all worried about that, and they're saying, well, this Genius means the US government is now de facto insuring stablecoin issuers, and we're going to bail out the crypto bros. You've never even had a run on a money market mutual fund that holds short-dated treasuries. There was one that broke the buck, obviously, in 2008 because they held like Lehman's commercial paper or something. Stablecoin issuers could not do that. They could not hold Lehman's commercial paper under Genius. So never been a run on there's $7 trillion in money market funds. There's never been a run on a money fund that's holding treasuries. What are stablecoin issuers permitted to hold under Genius? Less than 90-day maturity treasuries, cash, and banks. That's basically it. Like, there's nothing creative or unusual in there. The treasury market's literally the most liquid market on the planet. So I can't even conceive of a run on a stablecoin under Genius.
I mean, you could have like an extremely short term slight depeg in the case that there's an enormous demand for redemptions, like somehow before the stablecoin issuer is able to sell the treasuries to create the cash to give the redemptions. But we're talking like a mere hours, I think, maximum that could even possibly occur.
Yeah, and on the other side with bank runs, if you look at 23, the run on SVB and Signature, those are the fastest runs in history by far. They were on Thursday, I think March 8th, maybe 2023. There were $100 billion of withdrawal requests from SVB in 24 hours. We've never had anything remotely approaching that in history before. So people are aware of that. That's in the collective consciousness. And we have social media, right? So everybody's, communicating, SVB, you remember what Twitter was like. So everybody's going to remember that. So on the one hand, stablecoin run risk extremely low to possibly zero. On the other, commercial bank run risk, everybody's highly attuned to that. And every CFO is now aware of the risk and ready to pull their funds at a moment's notice. So banking system more fragile, stable coins stronger than ever.
Yeah, the combination of social media and the fintech banking apps themselves, like it's never been easier. You don't have to line up against outside Bailey Bank and Trust or whatever it was called. And It's Wonderful. Is it Bailey? The name of the bank?
George Bailey. Was it?
Yeah, George Bailey's. I just forget if that was the bank's name itself. But yes, in Bedford, in the movie It's a Wonderful Life, you don't have to line up outside the bank. You can literally just pull out your phone and withdraw your money like boop boop like.
And you know what? With banks embedding stablecoins in the core banking infrastructure, it'll be even faster.
Yeah.
So
I
not
agree.
to like spread FUD around.
Well, and that's the other thing too, is that the issuers can't rehype the underlying collateral. There's another fear that people had, was that we know that there probably will be demand to take your checking account balance and put it in a stable. It is safer theoretically and maybe pragmatically than the checking account deposit, even more so if you can get yield on the stable coin. But a lot of people, even if they end up getting paid in stable coins, will end up using custodial wallets like banks probably to hold the stable in a checking account. So and I don't believe there's any prohibition on stable coins are treated pari passu as cash, right? That's a big innovation in the Genius Act and a good thing. There's nothing saying that the bank that you deposit your stable coin with can't then proceed to do commercial lending with the stable, right? So there could be a net drain out of one form of deposit, but like a stable coin itself can become a deposit again and then be used. So one of the questions people have for me is like, will there be this giant, not only movement from unsecured bank deposits to stable coins, but also will bank lending be dramatically harmed? And I'm not so sure it will be. I think it will be net marginally harmed for sure, because some people like me might choose to hold my checking account stablecoin cash in a non-custodial wallet, which by the way is possible for the first time ever in American history. But also some will use things that aren't lenders like PayPal or Cash App or Venmo or Robinhood to hold their stablecoins. But surely a lot will flow right back into the bank, right?
Yeah, presumably. And every bank is considering their stablecoin strategy. So yeah, I do believe stablecoins are just going to be another line item type of deposit.
Let's transition, because there were some hilarious and hysterical criticisms against Genius, which in the end, I mean, really didn't resonate. Something like over 110 Democrats voted in favor with Republicans in the House, which is actually way higher mark to pass Genius into law. 69 total votes in the Senate, well over 300 votes in the House to pass this thing. So the critics didn't really make much of a dent in support. And actually a similar, almost as high a margin for the Clarity Act in the House, with 78 Democrats voting in favor, even more than Fit 21 in last year's Congress. But still this hysterical sort of progressive wing of the Democratic Party advancing some arguments. And one of the ones that they advanced for Genius quite loudly is that it effectively ushers in a new era of free banking, and that somehow that's like code for very bad. You've written about this and replied to this criticism a fair amount, and you've also written about free banking historically quite a lot as well. Nick, what is free banking, and are those comparisons accurate?
Yeah, I mean, it really rankles me actually, because they have this extremely blinkered view of what free banking is, and no one that invokes free banking appears to actually have looked at the historical record at all. And it's not like this information is hard to find. Like George Selgin has spent his entire career talking about this. So just like read any of his books. I don't know. And it's always these central bankers like, oh, it's going to bring back wildcat banking. The U.S. domestic free banking systems pre-Civil Wars, 1830s, 1860s, you did have banks, at the state level, were able to basically take in specie gold and issue notes against that. But it was actually it's not considered a classic. This is kind of a no true Scotsman fallacy here, but it wasn't considered a classic instance of true free banking, or laissez-faire banking it's called, which just means basically the money supply is not controlled by the central bank, is what free banking really refers to. The truer, more pure examples are found in Scotland in the late 1700s, early 1800s. There was an episode in Canada around the time. There's other episodes historically in Sweden and Switzerland, where the system was extremely stable, not inflationary, and the banks were held in check by competitive pressures, basically. The competitive pressures not to overissue notes. In the US, the system was much less stable because there were serious restrictions on the banks themselves. They were not allowed to branch, which means having many different branches, so they weren't able to get this geographic diversification. So if the corn harvest failed and it was the local Bank of Idaho or whatever, then the bank might fail, right? Because they're not diversified. The states also forced the banks to hold really subpar instruments. So they were very fragile. And so, yes, there were rampant bank failures during that era, but it wasn't a classic or true example of free banking. And so now these days, you have central bankers that will refer to that time, be like, oh, stablecoins are just like that. And you're going to have wildcat stablecoin issuers. Like the Wildcat Bank was a bank that would issue notes, take deposits, and then leave. It just, disappear, basically. They're worried that, in some cases in the free banking era in the US, you had the liabilities of the banks trading at different market values. So you'd have to do extra informational work to, determine whether this dollar issued by the Farmers Bank of Idaho is worth $1 in New York if you want to spend it. That's because there were restrictions on branching, so you couldn't get these more nationwide banks at that time. It's also because there's informational costs and latency costs. Like, to redeem the notes, there weren't really clearinghouses, mostly in the US. There were some. There was this one called the Suffolk system in New England. There weren't clearinghouses, so, there weren't these, there were costs associated with redemption. Like you'd have to physically go, and so that introduced costs in some cases. So there were discounts. This doesn't really apply to stablecoins, Stablecoins are these natively global institutions. It's not difficult to find information. There's no cost associated with finding information on the solvency of the stablecoin, especially post-Genius. That's very standardized, as you said. They are not engaging in lending at all. They're just holding treasuries. So there's no risk from the kind of balance sheet perspective, right? So I have made this comparison in the past. In the Crypto Dollars paper I wrote in 2020, I actually made a detailed comparison because I thought it was interesting, but it doesn't really fit. And, you have to recognize that like historical banking with physical paper notes with limited, ability to travel, right? Pre-internet, obviously, like I guess we had the telegraph or something, that doesn't really compare to the modern day situation. And like the reasons why those banks were unreliable and there was sometimes costly information with regards to the solvency of the banks, those reasons do not apply to stablecoins today.
Yeah, I think that's right. And even just one of the simple ones you mentioned too, the inability of the US based wildcat banks from even doing like cross-border stuff, right? Not hedging. I mean, having most of them having to be solely contained inside one state jurisdiction. That obviously doesn't apply here. And the quality of the assets. I guess, what is the naive reason why people are making this? Is it because you're going to have many different issuers and it just seems like a simple comparison?
Yeah, I mean, I guess stablecoins, it seems like a private firm issuing their own, taking in deposits and issuing their own liability, which is then meant to, function as money. And all these economists, like Gordon Zhang has written about this a lot. Gordon and Zhang, rather. They say that stablecoins don't satisfy the NQA principle, no questions asked. So that's the idea that for money to be efficiently utilized in society, whenever you use the money, you can't have any questions about what that money's worth, right?
Right. I give you $1, you look at it, for sure it's $1, you've received it, there's no further questions.
if I have questions, then we can't do commerce, right? But I think that's an unrealistic bar actually for any form of money, frankly. Like there is a guarantor always, and then also just empirically, stable coins tend to be worth $1, and like people very happily accept them, and they're also redeemable for the underlying dollars,
right?
Like,
especially under the Genius framework, which really codifies all of that stuff.
The redeemability is key. So when you send me Tether USDC, I do not have questions. So it's like always like economists would be like, yeah, it doesn't work in theory, but it works in practice, but not in theory.
Yeah, that's the strangest when you see that on any topic. You're like, well, then perhaps the theories need working on.
I don't like the theory. It doesn't seem good. It's not like a good model of the world because there's trillions of dollars of stablecoin transactions, and there are no questions asked, truly. And that's also the point of Genius, is to eliminate any lingering questions.
That's right, and it is quite comprehensive. So, wow. I mean, we're looking at a truly historic change to the way the U.S. banking system works, it sounds like. And do you expect all big banks or all banks to issue these?
I think so. I think you'll have consortia. It's very hard to be an issuer of a stablecoin. A lot of people have tried. Arguably, only 3 have ever succeeded. I would say Tether, Circle, and Athena is different, but I would say successful issuer. Maybe USDG and Paxos is stablecoin. I think they're also doing well, but very few have succeeded. You need to, band together if you're going to issue a stablecoin. So there's these rumors of JPM and BOFA and Citi doing a stablecoin. I think a lot of banks will mistakenly think that they can just do it, but they don't understand you need distribution for a stablecoin to work. Like all the major stablecoins that have worked have had the distribution of an exchange as the nexus. USDC with Coinbase and Tether with Bitfinex, and later all the other major offshore exchanges. It's going to be immensely challenging. But yeah, I mean, just based on the conversations I've had with several of the top 10 largest banks in the US, they will all issue or join some kind of consortium.
Yeah, it seems like they don't want to, at a minimum, they don't want to leak that 90-day or less treasury yield to just some other fintech, right? I think the interesting thing for me, the ICBA, which is the community bankers trade, they also heavily opposed Genius and wrote some angry letters. And I think, to me, this is like maybe the most interesting disruption. Like surely, JP Morgan Chase, the world's largest bank, could figure out how to launch one of these things, or a consortia of, banks could. But like, do you want to hold like a stablecoin issue, even though you should be able to, because they really are like federally minimum threshold. It's quite high in terms of all the safety but also in terms of the safety and the rules and all that. Even if you register with the state, that state regime still has to basically be as strict as the federal one anyway. But do you want to hold, like local stablecoin issued by a community bank in Spokane, Washington? I don't know. And so I think there's a fear among the community bankers that their depositors, who are largely comprised of workers in their local jurisdiction, getting their direct deposit, getting paid their salaries into a checking account, that they might end up receiving, JPM coin or Circle or Tether as the deposit. And now they're leaking, some amount of yield back to some unknown company. So there is an incentive for them to issue their own. To me, it seems like debit cards are pretty much the directly challenged by stablecoins, debit card holders, those types of checking accounts.
Yeah, I think community and regional banks will be challenged for sure. I mean, the US is actually a bit unusual with how many financial institutions we have. We have, I think 4,000, 5,000. Which is it's actually been declining significantly. I think the winners will be the largest banks. But I do also think that the window is opening again to get new bank charters, which is very exciting. So I welcome that. I think since the financial crisis, since Dodd-Frank, it's been virtually impossible to get a bank charter. I'm very excited for this new era now. All the banking regulators are signaling they're open to new charters. So you're actually going to get some competitiveness. And Chris Waller, the Fed governor, said, like, it's not my job to protect banks' profits. And he's basically admitting stablecoins will challenge the profitability of banks, especially as they lose the very cheap funding from deposits. And that's okay. Like, the banking system is not that good. Like,
yeah, let's roll that
fine.
clip. Let's roll that clip from Waller right now.
Stable coins are just a new method for making a payment. So stable coins are just a new dollar token, just like a poker chip, that is now going to trade over a different set of digital rails, typically the crypto rails, Ethereum, Solana, these various platforms. What is that going to do? It's going to open up different ways of making payments. These are fast 24 by 7 by 365 payment setups. They're just a dollar representation. They don't pay interest. You have to have them fully backed. There's no banking credit backing this up. It's just pure liquid assets, treasuries, or reserves in the Fed. And the whole idea for me is that this is just going to introduce competition in payments. It's going to make cross-border payments so much easier. It's going to make them faster, and it's going to make them cheaper. And that's the goal for me as a free market capitalist economist, is I want competition in payments to drive down the cost for households and consumers and businesses. That's it. Banks have to compete. Sorry, that's your job. So it's not my job to protect profits of individual firms. So that's it. But I want a level playing field. If you're going to introduce a stablecoin, let the banks in on it too. Then go compete. See what happens.
All right, Nick, plenty of discussion on genius in banking. Always interesting. Before we wrap, let's talk a little bit about AI. Like I said at the top of the interview, we talked a lot about AI last time you were on the show. You're an investor in CoreWeave and in Core Scientific. I think you both. And obviously, those companies have huge data center businesses tied to AI. Of course, Galaxy has a big data center business tied to AI. Before we get to data centers and energy and demand for the growth of AI, like, it's been a year. 3 years ago, what was the video like? AI threshold was like, can you make that video of Will Smith eating spaghetti? And it was like really, really bad. Now, like, Google VO's video is like incredibly good, but also LLMs have improved. Like, as a user of AI tools, how would you like characterize the last sort of year of advancement?
I mean, on the one hand, if you're in the trenches using AI tools as a white collar professional, I think you're blown away. And I think it would be very irresponsible if you had any kind of job and knowledge work and you did not use AI. Like, I would never hire someone that didn't incorporate AI into their ordinary processes. So I think the amount of compute per capita we're going to assume is just going to continue to rise through the orders of magnitude. At the same time, the diffusion of AI into the enterprise has been actually very slow, I think. So the corporate sector adoption curve is much slower than I expected. At the startup and entrepreneurial level, smaller firms, more nimble, less constrained, it's immense. What percentage of code now in startups is being written with AI? Probably at least 50%. So it is interesting. It's kind of contradictory things. Like, on the one hand, O3 Pro is, in my opinion, it is AGI. Like, I think that actually we've achieved it already. Not like super intelligence per se, but I would say it's better than humans at virtually any task that involves thinking and knowledge. Just got like a gold on the Olympiad. What's the competition called?
I forget, but yeah, it scored very high. Yes.
So, I mean, you're talking elite mathematical problems that professional mathematicians struggle with. AI can do this now. On the other hand, we haven't seen it affect GDP growth as I expected. I thought it would add a couple points, actually. So I do think there is tremendous inertia in kind of the largest firms. So the diffusion is actually slower than I thought.
Yeah, I think that makes sense. You want to see the efficiency gains from these AI tools translate into more revenue, more product, more everything. Are we seeing like layoffs because of it yet, you think? Or like, is it affecting the labor market?
Have you talked to like your like younger sibling or like friends that are younger that are just graduating from college. It seems like the labor market's extremely tough, actually, very, very challenging. But at the same time, as a VC and like an entrepreneur, I think it actually changed the balance of power between founders and capital. Founders are actually very empowered right now because they need less capital. The fixed cost of building a software startup is much less now. You just don't need as many humans to produce the same output. So it's the golden age of entrepreneurship. Like anyone, even non-technical, can build an MVP or an actual technical product now. So at the startup level, I think it's absolute golden age to be a founder, but it's not universally diffused, which is remarkable.
So how much? Well, actually, before we get into the how this is going to translate into the growth of energy and data center needs, you had an interesting post today about, you said if you wouldn't hire somebody that doesn't have these skills, and young people are finding it hard to get jobs. Are we worried about young people being able to develop critical thinking skills and also writing, which I think you would definitely agree with? Writing is thinking. If you can't think well, you won't write well. And I encourage my team, especially newer researchers, to work on their writing as a method of making their thoughts themselves coherent, understandable, relatable. Are we worried about the future generations losing these key skills of writing, thinking, and critical thinking?
Yeah, I'm very concerned, actually. Very, very concerned. I think people, if given the choice, would offload virtually all cognitive tasks to the AI. It's like we don't memorize maps of the city anymore. We just use Google Maps, right? And so we don't know what the city looks like. It worries me immensely, and I'm very glad that I completed my education before AI came to exist. I think there's just going to be so few parents that are willing to do the work pedagogically to, teach their kids, to make them literate. I think I think the literacy rate's going to collapse, right? And I actually am deeply concerned for future generations. I think it's going to be this massive Pareto principle where you're going to have like 1% or 0.5% of kids are actually going to learn to perform cognitive tasks. And the vast majority will just use AI to, do all educational tasks. And as a result, will learn nothing. But they will have brain-computer interfaces in a decade or so. So from the outside, they'll look extremely competent, but they won't have internalized any of the cognitive ability at all. It'll just all be outsourced.
So that's kind of terrifying. And I agree. I'm happy that I already did my schooling in education without these tools. Do you think it ends up, assuming that's what happens, does it end up more like Idiocracy? Or do we end up with an anti-machine revolution like in Dune, where these things end up getting banned? Is there some middle ground?
The Butlerian jihad.
Yeah.
No, there's no reversing it. There's absolutely no reversing it. So yeah, I think you'll have a tiny, tiny fraction of the population that will be building things, and the rest will be dependent. And so I do think this is actually what's leading people to support Zoran and other incipient socialist movements. I think there will be a huge upswing in socialism in the developed world as even educated folks become effectively irrelevant from an economic standpoint. So it does concern me a lot, actually. I think there will be some kind of rebellion, for lack of a better word, on the part of labor versus capital, which is coming in the next 10 years. I think you'll see extremely powerful socialist movements in this country as people realize how unbalanced things have become.
Foreboding. What does that mean, that growth and demand and reliance upon this for data centers, energy? How is your thesis evolving there?
Yeah, I mean, look, I'm tremendously exposed to that. Of course, all the Bitcoin miners now are looking to convert or sell themselves to the AI neoclouds, the CoreWeaves, the Crusoes of the world. And we're going to face bottlenecks very soon. We're already facing them. it's not, Zuckerberg talked about this on the Dwarkesh podcast, and you're talking about hundreds of billions of dollars being spent by the hyperscalers on AI infrastructure. I mean, Elon yesterday was throwing out some insane numbers on this, and there's also going to be an overbuild because you'll want redundancy at the sovereign level, right? Like the UAE and Saudi and Japan and China, they're going to want their own clouds. You're not going to want to run on some other country's cloud for your critical, like your military AI infrastructure, right? So there will actually be a massive overbuild. And I was just looking at the data recently, and I think we've now eclipsed the spending on AI infrastructure as a share of GDP when you compare it with the broadband, the fiber build out from the first bubble in the 2000s, the telecom bubble. I don't know, what do we call it? .com bubble. So we're now ahead of that, but we're not at the railroad level yet from the railroad bubble. So I think it'll go further actually than, because this is much more important than just the internet. Actually, it's, I think, much bigger economically speaking. So we're definitely in a, I don't know if I would call it a bubble, but like we're in this period of massive infrastructure overbuild, which I think will continue and go further actually than people might expect, because every sovereign will want their own. But the ultimate bottleneck, of course, is power, and we don't produce enough of it in this country. China is far ahead of us. It has to be nuclear, but nuclear takes so long. So we're going to reach that bottleneck very soon. I think we're reaching it. And if you look at the power prices in some of these markets, it's already kind of going nuts. And a lot of those inefficiencies have been scooped up. Like we used to talk about West Texas as this like plays with cheap power and Bitcoin context. And then you have Stargate plonking down multiple gigawatts in Abilene, Texas. I mean, if you've seen the development of these facilities, it's unbelievable. So we're running out, and there's just no way to bring power online fast enough. So we're hitting that bottleneck now.
Well, that's what the president said in his 2024 Nashville Bitcoin conference speech. We're going to have so much electricity. You're going to say, please, sir, no more electricity. It sounds like we definitely will need more. Nick, given all of these conversations we've had on crypto data and those markets, the expansion of stable coins, AI, energy, we haven't talked a lot about crypto or Bitcoin, and we're not going to, but maybe here, what is Castle Island focused on in the sort of near and medium term now for venture investing? What themes are you tracking closely?
Yeah, I mean, we aspire to be the premier stablecoin focused fund in the world. And I think we're probably close to that in terms of deal count, capital deployed. Stablecoin is such an interesting space. We're doing a lot in emerging markets. Scott Besson's obviously talked about this, but when you talk about like the growth sources for stablecoins, a lot of it will be substitution with moving from commercial bank dollars to stablecoins. That doesn't make a difference for us fiscally. What does is other offshore foreign markets doing currency conversion, currency substitution into stablecoins. So, and we think it's very good we think it's actually, there's a welfare reason to do that, right? And other foreign governments may not like it, but that's where we see a huge source of demand. So looking offshore, emerging frontier markets, facilitating dollarization and a free flow of capital and goods, which I think is very good for the world. And then looking at startups that are facilitating this transformation domestically from banking as it used to work to banking plus stablecoins. And that's going to be very challenging. Banks don't update their software very quickly, right? So there's a lot to do there. So those are the big themes for us. And then, of course, what we've always done since inception, which is, financial market infrastructure for crypto. We've been very consistent. Nothing's actually changed in 8 years of doing this, which is kind of interesting.
8 years. My God.
So I know it's been a lot.
Seems like not, just yesterday that you guys founded Castle Island up there in Boston. So much has changed. Well, congratulations on the success at Castle Island, Nick. Congratulations, the founder of Coinmetrics, on Coinmetrics acquisition. That's also a long time coming.
That was even longer. Yeah.
And this has always been great. Thank you for coming to Galaxy Brains. Nick Carter, founding partner of Castle Island Ventures.
Thanks for having me.
That's it for this week's episode of Galaxy Brains. Thank you to our guest, Nick Carter, founding partner of Castle Island Ventures, and our friend Bimnet Abibi from Galaxy Trading. Everyone have a safe and happy weekend, and we will see you next week. Thanks for listening to Galaxy Brains, the weekly podcast from Galaxy Research. If you enjoy the show, please like, rate, review, and subscribe wherever you get your podcasts. To follow Galaxy Research, sign up for our weekly newsletter at gdr.email, read our content at galaxy.com/research, and follow us on Twitter at GLXY Research. See you next week.